Welcome to Balance of Economy. Before we dive into the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers. Welcome to the debate.
Yeah, glad to be here.
So today, we're really digging into the evolution of global energy resilience, specifically looking at it in the face of these massive 2026 Middle East tensions.
Right. The core of it really comes down to whether modern efficiency has actually saved us. Like, are we truly resilient to this shock?
Exactly. Or, on the other hand, have the severe infrastructure scars and this unprecedented global debt basically trapped us in some inescapable inflationary crisis.
Yeah, the debt vortex, which, as you know, is definitely where I fall on this.
Right. Well, we're basing this off of recent market research, looking at the historical data, comparing 1973 to 2026, and really diving into the macroeconomic central bank policies. Now, I personally look at this and see a global economy that is structurally resilient. An isolated energy spike today just reorients consumer spending. It doesn't cause the kind of systemic inflation we saw decades ago.
And I look at the exact same data and see that vortex. We have massive infrastructure destruction and a $350 trillion global debt burden that makes this fundamentally worse than the 1970s.
Well, let's start with the 70s, because I think the world has actually learned from that era. I mean, look at the massive shift in energy reliance.
Sure.
Back in 1973, oil accounted for roughly 46% of world energy. Today, it's only 30%. Plus, the U.S. is now a net petroleum exporter.
Right, the fracking revolution.
Exactly. And our global fuel efficiency has just skyrocketed. I mean, we went from 13.1 miles per gallon in 1975 to over 27.1 today. So my core thesis is simple. A spike in one single commodity is not inherently inflationary, not unless central banks overreact and just, print money.
I acknowledge the efficiency gains. I really do. We have better light bulbs, better engines. But you have to look at the sheer scale of the current crisis.
Which is massive, I agree.
It's an 11 million barrel per day loss. That completely dwarfs the 5 million we lost back in 1979. And this introduces the concept of the infrastructure scar.
Right, the physical damage.
Exactly. We're talking about the actual physical destruction of assets, like Qatar's LNG trains and Iran's South Pars field. Supply chains can heal, sure, but destroyed supply? That takes 3 to 5 years to rebuild.
It takes heavy engineering, yeah.
And our structural financial foundation is infinitely weaker today. In '79, the U.S. was a creditor nation, sitting at positive 3.5% of GDP.
Oh, sure, the balance sheet was different.
Different? Today we are heavily indebted. At negative 85% of GDP, we are trapped under a $350 trillion global dollar-denominated debt mountain.
Okay, but let's break down that physical reality first. The 1973 versus 2026 comparison. The modern economy is structurally insulated in ways it just wasn't before.
Insulated how?
Well, look at the rise of alternative energy sources. Natural gas, nuclear, solar. I mean, the U.S. effectively banned burning petroleum in power plants back in 1978.
Yeah, the grid is different, but
National speed limits. We aren't going to have gas rationing. The domestic base load is secure.
I come at it from a different way. The West might have better efficiency domestically, but the physical destruction in the Middle East is locked in globally.
Globally, yes, there's a constraint.
It's more than a constraint. We're looking at a 17% direct hit to Qatar's LNG capacity, and a 95% drop in Strait of Hormuz traffic.
Wow, 95%.
Yeah, you can't just digitally conjure up specialized cryogenic compressors. That takes years. The physical damage is real, and it's permanent for the medium term.
I concede the physical damage. The engineering reality is brutal. But my question is, how does that physical damage actually translate to the consumer wallet?
It hits them directly.
It hits them, yes, but it moves the debate to inflation, which is where I think the mainstream narrative gets it wrong. Everyone thinks high oil prices guarantee inflation. They don't.
Okay, explain that.
Let's use an everyday analogy. Say the price of bubblegum rises. Demand is highly elastic, right? People just buy less bubblegum.
Sure, nobody needs bubblegum.
Exactly. But oil is inelastic. People literally have to drive to work. So the higher cost of oil forces what I call a consumer squeeze.
A squeeze.
Right. Consumers are forced to reorganize their budgets. For example, you skip your daily Starbucks and maybe you go buy coffee at Dutch Bros for 20% less.
Okay, but
Or eventually you downsize your car or even your home. The point is, GDP is rearranged, it is not destroyed, and it doesn't just magically inflate.
I'm sorry, but I just don't buy that. Let me tell you why. You're assuming a complete vacuum where central banks just sit there and remain passive.
They should remain passive.
But they won't. Think about your own example. When consumer spending on non-essentials like Starbucks plummets, businesses suffer. The hospitality sector gets crushed.
Well, yeah, there's localized pain.
It's not localized. The whole economy slows down. Unemployment rises, and government tax receipts fall drastically, which forces governments to step in.
Or they could just cut spending.
They mathematically cannot because of automatic social safety net obligations, which brings us to the debt vortex. It's a four-step loop.
Walk me through your 4 steps then.
Step 1. The oil shock slows the economy, just like we described with the consumer squeeze.
Right.
Step 2. Deficits rise as those tax receipts fall, which forces the U.S. to borrow significantly more money.
Okay, the Treasury issues more bonds.
Exactly. Step 3. That massive borrowing demand strengthens the dollar and pushes up interest rates, pulling global capital into the U.S.
Which makes our imports cheaper.
Domestically, yes. But step 4 is the killer. That stronger dollar completely crushes the $350 trillion in foreign dollar-denominated debt.
Because they have to pay back in more expensive dollars.
Exactly. It cripples the global economy, emerging markets default, and the whole loop restarts. That is the vortex.
I see why you think that, but let me give you a different perspective.
Go for it.
You are assuming central banks will just accommodate the pain rather than forcing the market to digest it.
What if central banks stick to a strict formula?
Like what?
Like, say, targeting 3% real growth and 2% inflation by strictly growing the money supply at exactly 5%, period. Doesn't the vortex break if they just hold the line?
the math won't let them hold the line. The U.S. interest expense would consume every single tax dollar.
Well, we both agree that central bank behavior is the ultimate fulcrum here.
Absolutely. It dictates everything.
Which leads us directly to the survival playbook. Given these immense pressures, how do prudent institutional investors actually need to position their portfolios?
Look, there are really only 3 exits to this debt vortex.
And none of them are pretty, I assume.
No, they aren't. First is a systemic deflationary collapse, which is what happens if your central banks try to hold the line. Second is intentional dollar devaluation.
Right.
And third is massive quantitative easing, specifically yield curve control to cap borrowing costs. All 3 of these ultimately lead to inflation.
So how do you allocate for that?
You have to prioritize tangible hard assets. Energy investments are huge because you have constrained supply but totally inelastic demand.
I actually agree with energy investments, but
And Bitcoin, frankly. It acts as a liquidity sponge when fiat debases. And you should be shorting the dollar with long-duration fixed-rate debt.
give an everyday example of that for people who think shorting sounds too risky.
Sure, think of holding a standard 3 to 4% 30-year fixed-rate mortgage.
Right, the classic homeowner strategy.
Exactly. Because inflation effectively pays off that debt for you over time. You owe fixed dollars, but the dollars become worth less.
See, I completely agree on the allocation to energy equities. They provide incredible real cash flow right now.
They do.
But I don't frame it as preparing for an apocalyptic debt vortex. For me, it's a grounded institutional strategy to capitalize on a multi-year infrastructure rebuilding phase.
But the rebuilding phase is exactly what drives the inflation.
I disagree. It's just the inevitable reorienting of global GDP. Capital is moving from discretionary sectors into heavy engineering to fix the scars.
We are arriving at the same portfolio, but from 2 totally different planets.
That's the beauty of it. So let me summarize where I stand. I really believe that modern diversification and consumer adaptability, that squeeze we talked about, will prevent a 1970s systemic collapse.
Assuming the central banks behave.
Provided central banks hold the line on the money supply, yes. The economy bends, but it doesn't break.
Well, my summary is simply that the math doesn't care about our efficiency. A $350 trillion debt burden paired with years-long infrastructure scars makes a really painful inflationary resolution inevitable.
But we do have a point of convergence here.
Oh, definitely.
Regardless of the macroeconomic outcome, whether it's my consumer squeeze or your debt vortex, the era of cheap, reliable global energy supply chains has structurally shifted.
It's gone. It's completely over. Institutional capital absolutely must pivot toward tangible assets and energy infrastructure right now.
Exactly. And it really shows the necessity of intellectual charity when analyzing volatile geopolitical data. You really have to dig deeper into these historical debt cycles to see the whole picture.
Yeah, the textbooks from the 70s just aren't enough anymore.
They really aren't. That's the data for today. Now, I want to hear from you. Is the global economy truly resilient, or is the debt mountain about to collapse under the pressure of energy prices? Drop your analysis in the comments below. And don't forget to subscribe to Balance of Economy for high-density market insights. Stay sharp and stay informed.